The Austin, Texas real estate market appears to be in free fall as the median home price has seen one of the largest declines in the nation. In today's video, we're going to be looking at where things appear to be headed for the Austin market, whether there are more price declines to come or if prices are beginning to stabilize. Let's get into it. The Austin, Texas housing market was one of the strongest markets during the pandemic, but has now turned into one of the worst performing markets in the nation. Let's not waste any time and get straight into the data to see what the current trends suggest is coming for the Austin market. The median home price in Austin stood at $443,000 as of May on a seasonally adjusted basis. This is down 15.6% from the peak of $525,000 in April of last year. This decline from the recent peak is significantly greater than the 3.1% decline for the nation overall from its peak last May through May of this year. At this point, you might be wondering why the Austin market is doing so much worse than the national average. In a word, supply. Austin has a much higher supply on the market than the national average, which has allowed for further decreases in the median home price. The month's supply, which measures how fast the current market inventory would be exhausted at the current pace of sales, came in at 3.9 in May for the Austin market. For the nation overall, there is a 2.1 month supply. We'll get more into the supply data later and what that suggests for prices moving forward. But right now, that is one of the major differences in price performance between the Austin market and the nation overall. Now, let's take a look at the underlying demand statistics to see what kind of market conditions buyers are facing and where things are headed on that front. One of the best indicators I like to look at to gauge the intensity of demand is the sales to list price ratio. As of May, this ratio was at 96.3, which means that homes are selling below list price on average. What is noteworthy here is that the current sales to list price ratio is below even where it was before the pandemic. However, in the last few months, there does seem to be some improvement here as the ratio ticked up in May after leveling out in April. While this is far from a definitive change in trend, I'm seeing improvement in other demand indicators as well. Home sales have certainly stopped their plunge over the last year and since hitting a low in November have actually been trending up. The average number of days a home stays on the market appears to be pulling back from its upward trend as well. All these signs point toward a stabilization in demand. I'll want to see a few more months with this trend continuing before reading into it too much. But the fact that we're seeing demand stabilize in multiple indicators gives me some confidence to say we could be facing a trend change in demand. Now, let's look at the supply side of the Austin market to get a better sense of what kind of price performance we could expect in the months to come. As previously mentioned, the month supply of homes came in at 3.9 in May, down from the recent peak of 4.6 in January. Supply has been tightening in the first half of 2023, which coincides with the change in demand I just showed you. New home listings also appear to be slowing down their declines as well. At this point, you might be wondering why we're seeing a change in market dynamics with supply tightening and demand halting its downward trend. The most likely culprit here is mortgage rates. The average 30-year fixed-rate mortgage came in at 6.7% as of June 29th, and while rates have been at high levels for more than a year now, they have stayed in a range between 6 and 7%. With the Federal Reserve signaling that they are far from starting to lower their Fed funds rate, which affects other interest rates in the economy, people are starting to get used to higher mortgage rates as part of their home buying calculation. Okay, so we're seeing supply tightening up, demand leveling out, and mortgage rates staying relatively stable for several months now. What does it all mean for prices? Ordinarily, it would suggest we would see prices rising, except that with the high level of mortgage rates still makes home buying very unaffordable for the average buyer. Here's a chart of the average housing payment as a percent of median household income. While we are down from the peak of 40.4% back in October, as of May it was still at 34.6%, well above where this ratio has been historically and above the 30% where the government considers a household to be cost burdened. For me, this suggests that rather than prices starting to rise again due to the change in supply and demand we're seeing, the median price is more likely to slow its decline before leveling out. We're still at very unaffordable price levels. We'll know more in the months to come when we could get confirmation on the potential change in demand trend. I'll provide an update on the Austin market after we get a bit more data in. So if you want to see that video when it comes out, make sure you're subscribed and hit that notification bell down below so you won't miss it. And if you found this video useful or at least mildly entertaining, please hit that like button as well to support the channel and help it grow. Thanks for stopping by, and I'll see you in the next video.